And in terms of the logistics of setting up such a structure, what we're proposing is an independent investment management organization with the capability to manage capital on behalf of multiple participants or jurisdictions. The revenue streams would be the sources of funds that belong to these individual provinces and localities. And rather than a single monolithic fund, we would propose a cooperative approach to managing separate pools of capital. So the benefit of this is that the capital would be managed by a professional investment team. It would have all the resources that it needs to be effective, but all the costs of personnel, technology, data, and such would be shared, keeping the cost reasonable, and each of the participants would be able to benefit from those economies of scale. But importantly, I think the ownership of each pool would remain with its contributor. So that would ensure that, for example, those funds are not diverted from one jurisdiction to another to, let's say, cover shortfalls in that other jurisdiction's investment portfolio. And I think another advantage of this cooperative approach is that the combined pools of capital would also be large enough to be considered an attractive investment partner, and they would be able to participate in large, complex transactions, and they would have the weight to negotiate good terms and low fees in their investment process.
Obviously, Canada has a federal model, and there are already, large pension funds in some provinces like OMERS and La Caisse de dépôt et placement. I'd be curious to ask you, Matt, the cooperative approach that you're proposing, is that in response to federalism in a way?
I think it is. I think it follows in that spirit. As we mentioned, the idea would be to cooperate on the management of the portfolio, but to keep the pools of capital separate. This would allow each participant to design their own investment objectives and guidelines. They would decide the types of investments that would be ideal for them, how much risk that they're comfortable taking. And they would also then have the flexibility to decide how to draw down from their pool, how to utilize the capital over time, and for what reasons and under what conditions it can be taken out. And as I mentioned earlier, importantly, the funds cannot be commingled in any way. There needs to be a firewall between the different portfolios. I think the other area of protection that we would propose for the participants is that at the end of the day, if for any reason a particular participant becomes dissatisfied with the services that they're receiving, they would have the option to take their money out of the program and find an alternative manager, whether public or private. I think that really leaves them with the ultimate control of their assets. And I think that might help funds that might help localities to get comfortable with participating, knowing that they always have the option to go down a different path if that becomes necessary. And I think also a more monolithic program would not be as attractive because of that fear of losing control over a particular jurisdiction's financial assets.
I'm just thinking, Matt's comment about sort of leveraging expertise and the backbone. I think right now of the Canada Growth Fund that was established, and the decision not to recreate an entirely new structure, but rather leverage the expertise and knowledge of PSP Investments, right? Scaling it and focusing it in a completely different area and with different types of investments. There's only so much expertise to go around. Let's use that expertise and federalism as a structure to our advantage when we're setting up a fund like this.